Hello, everybody. Welcome back to Every Day is Saturday. I'm Matt Stahl, along with my partner, Brad Gatto.
Howdy, howdy.
Like it. Today, welcome to our episode. We are going to be talking about the fees and expenses that can be associated with investing today. And
all of them.
Some of them
maybe. We think all of them.
We think all of them.
Maybe there's even fees we don't know about.
Yeah. And if there are, then let us know. But we're hoping to go a bit more than surface level from this, thinking a bit further beyond just a typical fee that we would see, to think about the real true cost and all those decisions that we have. So before we get into that, Brad, what's new?
Well, first of all, welcome back.
Thank you.
I recorded an episode without you.
You did, yeah.
It was weird.
That's what I asked you.
No, it was.
I imagine it would be
just talking into a mic by yourself. I got done recording the episode and I was like, I have no idea if that was any good or totally stunk, because it is funny. You get like this, there's a bit of feedback like built into a conversation between two people. And naturally, when the other person's talking, you have a chance to kind of put your thoughts together and just all this other kind of stuff. It gives you a little bit of this, a break, so to speak. And when you're the only one on the episode and there's no guest, so there's no co-host, but there's also no guest, I was dead convinced it was terrible when I got done. So welcome back.
Where did you look? Did you look at the camera?
Yeah, for the most part. Also very awkward.
Yeah.
Yeah.
Did you stop? Did you pause at all? You just ramble the whole time.
No, stream of consciousness for however long the episode was, 27, 28 minutes. I mean, the good news is it was part of my story, right? Yes. So it's not like I know my story. So it's not that I had to stop and be like, well, wait, what did I do again?
Yeah.
But anyway,
it's probably like a therapy session. There was probably some sort of therapeutic.
Yeah. Maybe it was a selfish episode. Maybe that's all it was. Like those moments in life where when you're growing up and you really don't want to tell on yourself to your parents, but it feels so good when you actually do it. That episode maybe had a little bit of
that. You got done and said, gosh, that Brad's one of the most interesting people I know.
Oh yeah. Yeah. That's exactly what I thought. My wife found out that, because we just released that episode. And so she found out that this was what it was about. And we started listening to the car and I was like, I don't know that I want to listen to this with you.
Yeah.
I don't.
I don't know.
This is very uncomfortable. But anyway, so welcome back.
Thank you.
I knew, I guess. We just I was gone for the last week. Part of that week was personal fun out in Napa for a couple of days with friends. So enjoyed some very, very good wine. I love wine. If you don't know that about me, I love Cabernet primarily, but mostly all red wines. And then on the back end, did a quick work event up in Seattle. So got to go straight from Napa to Seattle, and happy to be back. Nice. Because now we've been in the throes of baseball, but it kind of like hits this crescendo in June, and we're coming up on June as we record this episode. And I believe we have, if my memory serves, we have baseball 29 of the 30 days.
Oh my goodness. Wow.
So it's, we're getting there, but I love baseball. There's definitely a lot of nights where I'm like, we gotta go to the baseball field again. But every night when we get back, I'm just super happy to be there once I'm there and enjoy it. So it's a lot of baseball right now.
Love it.
You?
This tends to be the time of year where we kind of stay put more than other parts of the year. So
because it's worth staying here.
Yeah, well, yeah, that's one part of it. It's been beautiful around here. The soccer, lots of soccer going on.
Mm-hmm.
This weekend, we have a big charity event we do every year at this time, and so usually we spend our entire weekend preparing for that and setting up, and we still get to participate this year, but we don't do any of the setup. So I'm actually incredibly excited about just being able to be there.
Well, there you go.
Rather than doing all the stuff. So as you know, I'm a better beer than I am a doer. So I'm a people person.
That sounded like the fanciest way to say I'm lazy.
Strategically lazy.
I'm better at being than doing. That was very good language. I like that. Well, let's I don't know. I feel like I say this a lot with our podcast. Maybe I'm in the wrong industry. I always feel like in my head, I'm like, this is going to be a boring, isn't it?
It's
Talk
not.
about fees
No,
and expenses, but it's not because I think our industry does a better job of hiding fees and expenses than any other industry on the planet. Maybe not healthcare.
Yeah. And I don't know enough about that too, but I'm sure it's got to be close.
Have you ever walked into the doctor's office and known what your bill is going to be before you did anything?
No. That's true.
And there's zero expectation that you should know.
Yeah.
You just walk in, they do whatever they do, and you just kind of have to eat it. You're just like, well,
that's true. But in general, they only use one name for each type of expense. Whereas the financial industry, we have 4 names for everything. Yeah. Including the fees and expenses. So
I don't know. I don't know about the healthcare system to know if that's true or not. I just know that you walk in the doctor's office, you get x-rays, you do this or for whatever, like, and then you leave and you get bills from every department. They all have like firewalls up between them, and you don't just get a bill from the hospital. You get bills from the anesthesiologist, from the x-ray department, from the clinic, from the doctor himself, because he's like a private practitioner inside of that hospital. And you just have no idea. You're just like, I don't know if I've paid all my bills. I don't know. You know how many people I've talked to that are in, like, get a collections notice on a healthcare bill that they didn't even know that they had.
Yes.
And you're like,
because I actually experienced it.
Oh, well,
when you have 4 kids, you have a lot of chances to have a lot of expenses.
So maybe we're not as bad as the healthcare system, but there definitely is a lot of layers to the fees and expenses. So we've come up with what we think is a creative way to go through this. And so here's what we're going to do. We're going to go through 3 scenarios where we have 3 hypothetical clients or just people that are interested in investing or in this industry. We'll just call them clients. We have 3 prospective clients, and we're going to go through the prospective client story. And then, Matt, you're going to respond with the fees and expenses associated with that type of relationship in investing. Because as we see it, there's more than 3 subcategories, but there's 3 broad categories. So up front, the 3 broad categories are do-it-yourselfers, people that do not work with a financial professional in any capacity. Okay, DIYers for short. If you've ever watched HGTV, you know exactly what that is. So DIYers, I'm just laughing because I think of all the, do you ever seen those, gosh, what are they? Like the before, like, is it Etsy? Not Etsy. Maybe that's what it is. Where people like try to do arts and crafts. Pinterest, and it's like
Pinterest.
Yes.
Yes.
The Pinterest fails.
Oh yeah.
Thank you. People try to do Pinterest and then they show their version of it and it is so bad. The picture I've stuck in my head is this lady that was trying to make a dessert that looked like a chicken and like a baby chick, like a cute chick kind of thing. And baby chicken. And it looked like a monster. Like it looks so scary. Anyway, so DIYers, not that all DIYers are bad. DIYers, and then somebody working with a financial services professional in the commission-based world. And then the third scenario is going to be a prospective client working with a financial advisor in the fee-based world.
And fiduciary. So it's
a fee-based fiduciary advisor versus commission-based suitability standard advisor versus a DIYer.
Love it.
So we're start with DIY.
We're going to give them names.
Okay.
So
we purposely didn't prepare this. I'm going to come up with these names off the top of my head.
Okay.
All right. So I'm going to start with the easy one because it's my favorite hypothetical name. So you have John Lunchbucket. It's my favorite hypothetical name. If you're unfamiliar, I use it all the time.
Now what are you going to eat?
I don't know.
That's your only one.
Jane Lunchbucket? I don't know. Adam Smith. So John Lunchbucket is a DIYer. John is 62 years old. He is contemplating retirement in the coming weeks and or months. He has about $500,000 in a brokerage account at Vanguard that he's a DIYer. So of course he's managing that on his own. That is complete ETF portfolio. And then he also has his 401k through his employer, which, as most 401ks are, is a mutual fund-based portfolio at the 401k level. And then he has a small Roth IRA at Vanguard as well, also in an ETF portfolio. Totaling, he's got about $1.5 million in assets. He's doing okay. So John, that is John's situation. He's got a couple Vanguard accounts, taxable account and a Roth account, smaller Roth account, and then a 401k through his employer. And his primary objective has always been to decrease the fees and expenses. And as he sees it and understands it, he's got these Vanguard accounts, which his average cost of these ETFs that he is invested in is 0.08%.
Okay.
Or as our industry likes to call it, 8 basis points. So 0.08% in fees and expenses. And then in his 401k, doesn't see any fees and expenses. And so is assuming he has
zero.
He has none.
Which is an assumption that we will see occasionally.
So Matt, be the bearer of bad news.
Yes.
What are his true fees and expenses?
All right. So John, I hate to break it to you, but there's an acronym that is called TIN-STOFL. And we heard that acronym, what, 15 years ago?
Who do you remember where?
It was in the office of a big box retail firm that we were both at.
Ameriprise.
Yeah.
Why are you trying to hide that?
I don't know.
Then go to broker check and find it.
I'm trying to be professional.
It's not that that's good or bad. It's just where we were.
It was in the conference room there. That's where I heard it.
Okay. I just couldn't remember.
Yeah. So TIN-STOFL just stands for there's no such thing as a free lunch. And so if we think of a DIYer, so do-it-yourselfer, typically the reason they go down that path is focused on the expenses. So
yeah, why else would you do
it? If you really like it.
I mean, sure.
Super, super interested in it. And but for the most part, that tends to be the reason. And a lot of times it's because those particular people may have had a poor experience with working with a financial professional.
Sure.
So if we're focused on that, let's focus on the Vanguard piece first. So ETFs, exchange traded funds, that can be a much better option than other options that would be out there. And John could have gone through and decided to choose all his own individual stocks and bonds within that portfolio. If he wanted to go get really detailed. In that scenario, he would run into some expenses that I won't go through here, but with the exchange traded funds, there is going to be that internal expense because each of those funds is a basket of, if it was a stock ETF, it's a basket of several stocks, right? So it turns out it's not free to buy anything. Wall Street doesn't work for free.
Right.
And so any transaction that takes place out there is going to trickle down to us in some fashion. And so the ETF portfolio is actually one of the better options that he could have that you could have chose. I'm dehumanizing you, John.
Yeah, come on.
Yeah. So,
let's go. I'm right here.
Let's go. Right.
I'm like right here.
Look at my eyes.
I'm sitting right in front of you.
So it is actually a better option than you could have chose, John, because you do have those internal expenses. And from a tax standpoint, it's actually one of the better decisions you could have made, which we will get to that later. Make sense?
Okay. So at my Vanguard accounts, that expense ratio is the only expense I'm paying?
No, it is not. So I like to think of this as layers of the onion. And this is not
if I don't like onions.
Layers of a blooming onion.
Oh yeah, now that you dipped it in batter and deep fried it, it's way better.
It's
Everything's better.
What's another layer thing?
That's called the state fair mindset.
Is that real?
Yeah, I just made that up.
Okay. Your blooming onion, it's layers of the blooming onion. But think of it at these different levels. So John, when you made the decision to go open your own brokerage account and go invest, you actually made a series of several decisions. Number one, you chose your custodian.
Mm-hmm.
So if it's at Vanguard.
Which, by the way, Vanguard's not good or bad. We're not picking on Vanguard.
No.
Okay. So none of this stuff, one, we're painting with a broad brush. Massive disclaimer. Disclaimer number two, if I use specific examples, it's not because I think that example is a good example of like a custodian or a fund manager or something like that. It's just because I'm picking one to make the story sound more real.
So it's familiar. Yeah. So your custodian is Vanguard. It very well could have been Schwab or Fidelity or these bigger names that you hear out there. And your custodian, their responsibility is to custody your account.
Yep.
So they hold your account, they issue tax forms, they report to the IRS, among many other things. Those are the big things that you're going to experience. At the custodian level, there can be expenses. There may be custodial fees. So you may be paying a fee per year just to have that account to Vanguard. As we dig a little bit deeper within that, at the custodian level, I keep wanting to say custody level. At the custodian level, there are other actually buried expenses that you may not see if you don't really dig in there. And that could be cash sweeps, that could be payment for order flow, that could be bond markups and markdowns. And
that all sounds
you got all
really
that?
detailed, and
So
you're gonna have to help me because
okay.
I'm a pretty smart guy.
Okay, so
But
cash
you lost me.
sweeps. If you look in your Vanguard account, but you have your $500,000 Vanguard account, you have $20,000 sitting in cash.
Yep.
You decided to do that because you're in retirement, you're pulling money out, you wanted some liquid money in there.
It's my money, Matt. Don't judge why I have cash or I don't have cash.
Yep. Sorry, John. The dehumanizing you again. So John,
I love playing my role. I was built for this role.
I was built for this role. You get to turn the table a little bit here. Yeah.
So it's also ironic because of the two of us, the fact that you're stuck in the technical role and I convinced you to be the technical guy through the whole episode.
This is not right. How did this happen? The cash sweeps. But if you look at your cash, and this is not an actual number, I'm just giving you an example. You're earning 0.2% on the cash sitting in your brokerage account.
Yep.
What you could actually earn should you go somewhere else is closer to right now 4%. Okay, just as an example. So I'm Vanguard, the custodian. I'm going to take your money that's sitting in that account. I'm going to go out and shop that and get 4% while I'm only giving you 0.2.
Right.
Make sense? So again, it may not be a direct expense that I see, but it is an opportunity cost for certain.
Sure.
Make sense? Payment for order flow. So if you decide to go make a trade of some sort and say you're going to go buy an individual stock, you've already got a stock tip from your cousin Joe, and you decide to go purchase that. Well, if you got that stock tip from who knows, this research company or that, or Yahoo Finance, there may be a lot of other parties out there that are deciding to make that same purchase. And guess what? They're bigger than you and they have a little bit more pull than you do. So
I don't know. I got $500,000 here.
Yep. Yeah. So they can actually pay to have their order placed ahead of yours to get a better price. And that can happen. And it can still happen.
So fee number one is one I probably can't necessarily, like, it's opportunity cost of the fact that they're getting better yield on my cash than I can get, that I'm currently getting. And so they're kind of skimming off the top from a cash perspective. Payment for order flow is just a fancy way to say that I'm trying to make a trade. Other institutions are also making that trade, or people with just more money that can kind of pay to put that trade in. And so instead of getting the stock at $5.31 a share, I end up getting it at $5.35 a share because of that payment for order flow.
Exactly.
And that's a cost to me.
Yep. Exactly.
Gotcha.
Third could be a bond markup or markdown. So again, within that exchange traded fund, or if you decide to purchase a bond, an individual bond on your own, the price that you see may not be the actual price. There's likely some sort of markup at the Vanguard level on the price of.
Wait a minute. You're telling me these custodians mark some of these trades?
It turns out they make money.
Come on.
So turns out they make money too. They don't become giant institutions by not making any money.
Isn't it funny though, even as you and I have this conversation, out of character, by the way, but I'm not John right now.
You're not John right now.
No.
Okay.
Out of character.
You're staring me down. It's uncomfortable.
Well, you're telling me all these fees I'm paying.
John, I don't think you should be a client.
You stay DIY. It makes sense when you stop and think about it for just a hot second of, well, yeah, Vanguard's making money.
Right.
And it's not just on the cost of the funds themselves, like the ETFs, right? Because usually that's fairly, yes, there's a markup there and there's some margin there for them inside of that 8 basis points. But it does cost money to run that fund.
Right.
And so it stands to reason. It seems completely logical when you stop and think about it. They're skimming somewhere else. There's a fee somewhere else. There's some other place that they're making money. And we've just mentioned 3 of them through cash, the timing of your order, essentially, and then a markup on a bond trade.
Yep, exactly. That's just one level. So now we're going to take it down to the level of you're in a Vanguard portfolio. So where the account is held now, what is the account invested in? And so that in this example, if you're at Vanguard, you're likely going to be in Vanguard ETFs.
Yep.
And so we talked about the expense ratio. That's something you can go find and research and is public. But beyond that, there might be transaction costs that you actually don't see again unless you dig a bit deeper within that level.
Well, maybe you can't ever even see,
Yes.
even if you dig.
Right.
Because Wall Street is actually, we'll talk about this too, an example in the next example. We'll dive into it more. Is Wall Street is actually allowed to embed fees and expenses inside of packaged products without having to disclose them to the general public.
Yep.
So I'll pause there and not get in any more detail into that until we get to scenario number 2. Anything else for the DIYer? For John?
Yes. Hold on. We're not done. Sorry, John.
Oh boy.
The
this is like a medical bill.
It is. From a tax perspective, you're actually in pretty good shape there. The decision you made on your brokerage account, it could be worse.
I only have type 2 cancer. Got it.
We'll get into that. Now let's move on to your 401k. So, John, how much are you paying for the money in your 401k?
Well, there are no fees.
Yeah, there's no, yep. Let's dig a little deeper in there. I see a handful of mutual funds within here that are kind of the cast the usual characters, which not saying that's a good or a bad thing, but you work for a very large corporation. We tend to see these same list of mutual funds. So I'm very familiar with these.
Yeah.
And turns out there's internal
Wait a minute. Everybody else's 401k looks like my 401k.
Pretty similar. As we look in there, turns out there's internal expenses within these mutual funds, and they're quite a bit higher than in your Vanguard portfolio. So this mutual fund right here, the internal expenses are about 1.2%.
Wow.
Yeah. And that's just what
that's a little bit more than my Vanguard portfolio.
It is. And that's just what's on the surface level. So again, we can dig a bit deeper, and there's additional transaction costs within there. And on top of that, there's actually a tax piece here as well.
What do you mean by that, man?
So yeah, I was waiting for that. I was just gonna sit in silence.
Great for podcasting. Just silence.
Yeah. Okay. So you have ABC Mutual Fund.
Yep.
And you know what? Let's save this. I'm gonna save this for when we get to our next scenario. But there is a tax piece hidden in here as well.
Okay. So I've got mutual fund expenses that are, I would say those are the most obvious fees or expenses associated with the 401k. There also could be admin costs, right? Depending on the 401k. Some 401ks just have a baked in admin cost, kind of an account fee, if you will. And some 401ks do have a financial professional attached to them.
Yep.
And of course, that financial professional is not working for free either. And so there could be that expense attached to your 401k as well.
Yes. anything
I'm missing?
I don't believe so.
Okay.
Yeah. Is that all your accounts?
Well, I had the Roth at Vanguard, but that's going to follow the same
Yep.
song and dance as my taxable account.
So we do still have this tax piece that's hanging out there that I want to get to in one of our next scenarios.
Okay. So scenario number 1, DIYer John, we're retiring here for a second. We're going to go on to scenario number 2. My name is no longer John. My name is Bart.
Oh, love it.
I don't know where that came from.
Hi, Bart.
Thank you. Last name Simpson. I don't know if you ever heard of me. We'll just go with Bart. Okay. My name is Bart. I am 70 years old.
Okay.
Married and retired. Wife also retired. And I've got $1 million in an IRA.
Okay.
And $50,000 in a taxable account.
Okay.
That's my situation.
Okay.
Do I get this working with you, who in this scenario are a commission-based financial advisor?
Okay. Do I get to give myself a name?
Sure.
Can I be Slick Eddie?
Oh, wow. Okay.
Yeah.
I feel like you're showing your bias a little bit by naming yourself that, but whatever, your podcast.
How about just Eddie?
Okay. Yeah, we'll drop the Slick.
Okay. All right. So my name is Eddie. I have this business card here that says financial advisor on it.
Mm-hmm.
So that means that I'm an expert in all things. Make sense?
Me too.
All right. And Bart, you came to me, and I am really focused on making money at this point in my life. So, Bart, I'm going to be real straight with you here. So, I have a confession to make. When you showed up, all I was thinking about was the dollars. Okay, so the
Does every commission-based advisor feel like this?
no,
Okay.
no, I'm taking it to the extreme.
Okay.
We're illustrating an extreme to just I want to give people an idea of actually what all the whole spectrum that's out there. Okay,
I just wanted the disclaimer.
Not every commission-based advisor is bad, and that's
And not every fiduciary advisor is good.
Right, exactly. So in this scenario, I'm going to be a little bit further on the what I would consider not good spectrum. Okay. So you came to me, you have $1 million in an IRA. That got my attention right away. And
okay.
So I have a handful of these mutual fund portfolios that were created for me by wholesalers from the mutual fund companies.
Mm-hmm.
And some of these pay me a good chunk of money for putting your money in them. Okay. So
are you trying to tell me that you could make a different amount of money depending on which investment that you put me in?
Yes.
Doesn't that potentially put you at odds with me?
Yeah, it could. Yeah.
Well, I'm glad your name's not Slick Eddie then.
That's why I'm making a confession.
Okay.
So, when you came in and you chose to work with me, because my card says financial advisor on it.
Yep.
And I told you all the stuff I know about the stock market.
How long was that conversation?
2 hours. I just talked the whole time. Remember, you didn't say anything.
Yeah, I'm uncomfortable right now.
So, anyways, I chose to put you in what are called retail mutual funds.
Okay.
So, because I feel bad.
Eddie, what is a retail mutual fund?
Retail mutual fund. So, of that $1 million portfolio in your IRA, one of those $100,000 we put into a mutual fund. Now let's look at this. This is ABC Mutual Fund, and it has the letter A at the end of it. And
so the ticker symbol is ABCA.
ABCA. And what this means is this was a retail mutual fund, and at the top level, again, we're still dealing with the custodian. So I happen to work with Schwab. Okay. Charles Schwab. Not good or bad, it's the custodian. So all those things we talked about before, what the possible expenses exist.
Yep.
Now we're getting into the mutual fund itself. Because of the A at the end of the mutual fund, that's actually telling you that I got paid 5% when you put the money in to the
plus or
IRA.
minus.
So around that neighborhood.
Yep.
Okay. I'm making this up. I can say whatever I want.
Wow. Just lends great credence to this episode. I'm making all this stuff up. What are you talking about?
It's a scenario. So
it is a scenario, but it's worth noting that
yes.
That 5% is there's a reason you pick that number, because that's a fair number.
Right.
It's not the highest, commission you could earn from an A-share mutual fund, but it's not the lowest either.
Yeah. So let's say it's 5%.
Okay.
So the day that I invested your money, I got paid 5% on your $1 million IRA, and I'm likely not going to get paid again on that. So
does that mean that if I put $1 million in, where did the 5% come from?
That's my commission.
But where did, when I put the $1 million in, do I have $1 million? Where'd the $50,000 go?
No, that's coming right off the top of your.
So when I invest $1 million, it actually only $950,000 goes in.
Yeah.
And right away, 50 grand goes in your pocket.
Yep.
Gotcha.
Yeah. Yeah. So beyond that, within these mutual funds, there's also internal expenses. And so we dig into that a little bit.
So there's your fee and expense, your labor,
yep,
but then the mutual fund in itself has the same cost it would have if it was in a 401k or any other place.
Yes.
So unlike when I buy it in my 401k, where I don't pay that upfront sales load necessarily, or commission, I still have all those same internal fees and expenses, but because I went to you, a commission-based advisor, that is how you got compensated, and I've got to pay that fee right up front.
Yes. Yeah. And the reason
do all commission-based advisors get paid that way?
No, they can choose. I could have chosen to put you in a C share, where I would get paid 1% each year.
But what
And
then where does that come from?
that
Like,
also comes off the
so if
top.
I put $1 million in, do I get $1 million right away? Do I
Nope.
still have $1 million?
It still comes off the top of your investment.
So let's give an example here. So let's say it's ABC mutual fund,
Yep.
and the cost of that fund, just for ease of conversation, is 1%. So if you buy the A share mutual fund, the advisor is going to get paid, in our example, 5% upfront. So $950 actually goes into your account, and then you're going to get pinged for that 1% per year, and that just gets dripped out, right?
Mm-hmm.
If you chose the C share, that extra 1% that the advisor is getting paid just gets wrapped into that internal expense. And so instead of, in my example, it being 1% per year for that fund is probably going to be 2% per year. Yes. 1%, which the mutual fund keeps, and 1%, which goes to the advisor.
Yep. Yes.
Right.
The what I discovered was we put your money in 3 years ago, and because I got a big payday, as the years go by, I kind of forgot about you, and that's why I'm feeling guilty.
Okay.
Because I got a big payday up front. Make sense?
Yes.
So I'm coming to you with a confession.
This is a long road to get to the confession.
That is my confession. I got a big payday. Let's dig a little bit deeper. So those are the 3 levels. I'm not Eddie any longer. I'm back to being Matt. So we have the custodian level.
Yep.
We have them at the mutual fund level. This time we do have the labor piece in there as well, because the advisor was paid for going out to pick those mutual funds and do the research on those. We gave an example of how they were chosen to be paid on that, but the actual materials cost of those mutual funds is also included in there. That's the internal expenses we're talking about. Make sense? So
let's wrap up I just want to wrap up this whole share class, like A share, C share, that kind of stuff, because it'd be very confusing. And then let's talk a little bit about the tax piece before we go to scenario number 3. So we gave a couple of options: an A share mutual fund, which is a front loaded, advisors paid right away. They do get a little bit of a trail. It's mostly upfront, and they get usually about 0.25% per year, trailing, which of course is significantly less than the upfront portion of it. And this is also not to say that any advisor that takes their comp up front like that is necessarily bad or not going to do what's in your best interest or what have you. But of course, it does represent the possibility for a conflict of interest. Just to be very frank, like you and I also do, excuse me, outside of the securities world, we also do insurance business. And insurance business is this way. Mm-hmm. And so you run the risk of getting into a relationship that somebody is just seeking out a paycheck and not seeking your best interest. But that said, A share is primarily up front. C share is primarily this ongoing trail-based type compensation. There are other share classes. There are non-loaded funds. So there are mutual funds that don't pay an upfront load like that, where the advisor has to charge a separate fee in order to get paid. But the bottom line is, if somebody is recommending a portfolio to you that has mutual funds in it, it stands to reason that outside of the fund cost of the mutual fund itself, they're getting paid some way, somehow, whether you can see it or not. Yes. And so the best practice, I guess, is just to ask, how are you paid on this particular investment? And does that represent an opportunity for you to do something that's not in my best interest, or where can the potential conflict of interest arise? Because a potential for a conflict of interest is there, doesn't mean the person's taking it, right? The advisor is taking it. It is completely possible that advisor genuinely believes that recommendation is in your best interest, even if it presents them with this paycheck. Yes. Right. Yep. So, but there's everything from A shares, B shares, C shares. Then you get into institutional shares, non-loaded funds. And then even inside of retirement accounts, they have R shares and Y shares and all. I mean, it just gets crazy. Yeah. One mutual fund can have all these different iterations, and it's all just kind of delineating the fees and expenses associated with the fund itself. The internal costs can change. The same mutual fund can have multiple different layers of internal costs, and also the costs associated with the advisor. So, yep.
We're not done yet. So, because you own mutual funds versus exchange traded funds or ETFs, there's actually a tax component to this as well. And
I don't have to pay taxes.
So yeah. So ABC mutual fund.
I love how you just blew past that. It's like, I'm not even going to address that.
Bart,
Bart, I got bad news for you, buddy.
somehow, somewhere.
What do you mean you haven't filed taxes in 10 years, Bart?
As we dig into the mutual funds in a little bit more detail. So ABC Mutual Fund was started, this is theoretical, started back in 1980. And within the reason I would have chosen to put my money into a mutual fund is because they're going to go select a handful of stocks or bonds. Let's just stick with stocks to provide me with diversification, because I didn't want to take the time to go do it, nor that I have enough money to spread it across that. Okay. So ABC Mutual Fund started in 1980. They started with their basket of stocks they chose, and they, within there, sometime in the early 90s, they invested in Apple stock. And you own one of those mutual funds, Bart. And it turns out in 2020, a lot of other people that own that mutual fund got a little bit uncomfortable, and they decided they were going to sell their holdings of ABC Mutual Fund. Follow me so far?
I am. I don't understand my problem yet.
Okay, we'll get to that.
All sounds fine so far.
So because other people are selling their shares of ABC Mutual Fund, ABC Mutual Fund is going to have to sell their shares of Apple stock. Make sense?
Yes.
Okay. When you purchase a stock in the early 90s and you hold it for that long, we run into what we call capital gains. So you're familiar with capital gains, Bart?
Yes.
Okay. So
the stock went up.
The stock went up. Yes. Better problem than it going down, right?
Yes.
However, we are going to have a tax bill associated with that. So as ABC,
I just got into the fund though, so I don't care.
So yeah, good observation. I would love to be able to tell you that's not the case, but guess what? You got into the fund in 2018, but ABC Mutual Fund has held that Apple stock since 1992. And when they sold that, there's a tax bill. Who do you think's paying that tax bill?
Well, not me. I just got in.
You would think so, right? So you're actually on the hook for their tax bill all the way back to 1991. Hate to break it to you.
Well, that's not very nice.
So it's not. So, and I'm sorry.
Well, you need to fix it.
And role play.
The short story there is it's group taxation. And so the example I like to give is, to oversimplify, is if you wanted to go in on an investment property with your family, your siblings, and you have 3 siblings. So the 4 of you buy a piece of investment property and one of those siblings wants out. In that scenario, it seems pretty obvious that decision by that one sibling is going to affect the other 3.
Right.
You have to buy them out. There's possible tax consequences, all of these sorts of things.
Yep.
It's the same thing in a mutual fund. It's just that there's not 3 siblings. There's tens of thousands of people you don't know.
Right.
And there's money flowing in and out of that fund every single day. And so it could be forced distribution because people are, there's money flowing out of the fund. And so the fund manager has to raise cash to satisfy those distributions and therefore sells out of a long held stock position that has a significant gain. It could just be, for whatever reason, the mutual fund manager chose to sell it, not because anybody necessarily wanted them to, but because they thought it was in the fund's best interest, regardless of your tax bill that it was going to generate. And so at the end of the day, anytime you get into a product that the tax impact or implications are done in a group setting, it stands to reason and seems pretty obvious when you start to think about it. Well, that has the potential of having a massive negative impact on me, especially if, one, I don't even know what my mutual fund holds. I don't know what stocks are in there. I don't know the tax liability associated. And then 2, like what I just kind of mentioned, is what if you get into a fund that's sitting on a treasure trove of taxes and you have no idea? And so you could be buying kind of a tax time bomb and you're just not familiar with it. And mutual funds, to their credit, have been around for a long time. They've done great things for investors for decades, 100 years, really. Almost 19, I think 29 was the first mutual fund, I want to say, give or take. But they've continued to get bigger and bigger and bigger and bigger and bigger and bigger. And there's a lot of problems that can come with that. One of which is this tax problem that we're talking about here.
Yeah. They can become a victim of their own success and not be able to be as nimble when they get to that point, because they're stuck in a position.
Absolutely. Well. All right. So for the sake of time here, do you have any more fees to talk to me about, or can I move on? Is Bart feed out?
But I think your feed out. There's also 12B1 fees, but because you're on mutual funds, there can be 12B1 fees.
Oh, you know what? There is one more thing that we have to bring up. Even though I'm the guy that wants to move on and, stop, killing Bart with fees here. The stated expenses of the mutual fund are very, very rarely the actual expenses of the mutual fund. And so if you look up the expense structure of that mutual fund, it tells you it's 1%. The odds are in favor that it's significantly higher than that, because Wall Street does have a whole list of fees that they do not have to disclose to you and I. Not just you, not just to Bart, the average lay investor, but also to me as a financial advisor. It's not information I have either. They are legally allowed to charge for trades and other things without having to disclose what they charged you for those trades and internal expense cost, some other basket of things that they don't have to disclose. And so it could be very possible that you get into a mutual fund, it tells you the fee is 1%, when in reality, it might be closer to 1.2, 1.3, maybe even more, because of these undisclosed fees and expenses that they just don't have to tell you about.
Yeah.
So that's fun.
Yeah. You done? Bart, you done yet?
Yeah.
Have you had enough?
I've had enough. Let's move on. Scenario number 3. So now, my name is Daniel, because that is the most popular name at Fiat Wealth Management. My name is Daniel, and I am working with a fee-based fiduciary advisor named.
I was going to say Daniel.
You go by.
I'll go by Brad.
Okay. Okay.
Bill?
Okay, Bill. Let's just do Bill.
Bill.
Okay. So I'm working with you. You're Bill.
Yep.
I'm Daniel, and I'm 55 years old. I'm not yet retired. Single guy, and I've got a 401k at a previous employer. It's sitting out there. It's orphaned. And it's got about $250,000 in it. And then I've got about $100,000 in a brokerage account. And then I've got my current 401k and my current employer that's got about $500,000 in it.
Okay.
That's my situation.
Yep. All right. So let's start with your current 401k. We're going to make the assumption that you only have the option to use their
fund lineup.
Yeah, that exist. And the fact of the matter is, you're going to have expenses, but because we work together and we dug into it with each other, we're educated in all that. We know exactly what those expenses are.
Yep.
Okay. So some of them are going to be unavoidable, but within your old 401k, same thing. You don't have the option to do in some cases you can do a self-directed 401k, but we went through a long and thorough conversation and dug into all the expenses that you're paying in your old 401k. And we actually compared that to a new portfolio, structuring it as an advisory agreement where our firm would actually be paid to go out and select your investment options. And
how are you paid?
So we're paid an advisory fee, and that is transparent, and that's, you see that on your statement. And because we work with we have a chief investment officer that is external to our firm, that is plugged into what I would say the backside of the matrix. We have a lot more education on what are the exact expenses we're going to pay for each of those decisions that we're making. So we decided to choose a basket of ETFs because we're not going to run into that tax scenario we discussed earlier. And we're very clear on what the turnover is within all those exchange traded funds, and also what the stated expense is.
Yep.
So as we dig into that, we compared the two. We actually found that with paying us the labor cost to prepare your financial plan, you end up paying about the same as you're paying in your 401k before, without getting any advice.
Gotcha.
Does that make sense?
It does.
In your brokerage account, we actually found the same thing as we dug into where you were investing before. You had a basket of mutual funds. There was a lot of turnover within those, so there was a lot of expense, and there was a whole lot of overlap of similar investments. So as we dug into that, took a microscope to that, we also found that we could be a lot more efficient. And again, you're still paying our firm, but that is transparent, and that's out in the open.
So let's talk about that a little bit more detail.
Yeah.
So as a fee-based advisor,
Yep,
you're paying an advisory fee.
Yeah.
But what does that mean?
Yeah. So let's go back to the example of Bart. So Bart, when you went to go work with Eddie, Bart had $1 million. The day that Eddie placed that trade, $50,000 came out of the account.
It's good memory.
The
right names, right amounts.
yeah,
Nice work.
That was a lot. The in this scenario, say that Bart instead decided to come work with me, Bill.
Bill.
So, if if he had decided to come work with Bill, yes, we decided that he's going to pay 1%. That's just an arbitrary number I'm throwing out there. 1% per year,
but not that arbitrary, because that tends to be
on the average.
A fee.
Where things, but that's only paid as you go. And what I mean by that is $50,000 is not coming out of the account immediately, nor is $10,000 coming out of the account immediately. It is 1% on an annual basis. So I'm going to take that divided by 12. So
some advisors buy 4, they bill quarterly. So
right.
You pay as you go, and it's a percentage of the account.
Yes.
Typically right around 1%.
Yes. And you see that on your statement each month or each quarter, very clearly spelled out. And because I consider myself a very good advisor, we had that conversation from the beginning, and we were very transparent about all the fees and expenses that we can dig into.
Sure.
Make sense?
So the only way that you're paid is off that fee, or are there other ways that you can be paid outside of that advisory fee, that 1%?
For your investment portfolio, that is the only way. So, yep.
So if you pick ABC mutual fund or XYZ ETF, it doesn't matter.
It does not matter
to your pocketbook anyway.
Does not matter to my pocketbook. No.
Gotcha.
Well,
so when it comes to packaged products, though, it doesn't matter if I'm Bill and I'm working with a commission-based advisor, or Daniel and I'm working with a fee-based advisor. Packaged products, we call that internally here at Fiat materials costs. They have the same materials costs. It's just that it's possible that with the commission-based advisor that they've also wrapped into that a commission inside the product attached to also that materials cost. But is it different? Like if you, as a fee-based advisor, buy ABC Mutual Fund on behalf of your client versus a commission-based advisor buying ABC Mutual Fund on behalf of their client, is it possible that the actual expenses of that fund, forget how the advisor is paid for a second, is it possible that the expenses of the fund itself are different?
That's a great question. So there we get into institutional versus retail funds, and it actually can be possible. So if you think of a retail mutual fund, that just means that anyone has access to that. So anybody you see walking down the street could go purchase that. And in general, those folks make decisions a little bit different than institutions.
Sure.
So institutions tend to move a bit slower, be a bit more methodical in their decision making. So you don't see as much turnover.
Yeah.
And so I could compare two the exact same mutual funds. And if one's an institutional and one's a retail, then the expenses of the institutional could be much less than the retail fund.
Yeah.
So that makes sense?
It does. It's so less layers, I would say, and more transparent.
Yes.
So it doesn't, even if you don't agree that a fee-based advisor and the way that a fee-based advisor is paid, like even if for whatever reason you like the idea of a commission-based advisor, it is still true that it is more transparent typically with a fee-based advisor and a little bit less on the layers perspective.
Yes. There's no option to not be transparent.
Right.
Does that make sense?
We can't hide.
Right. Yes.
Perfect. Anything else that I need to, or are we through with Bill and Daniel? I almost forgot our names again.
I think we're through.
So we made it through. So here's how I would love to wrap this up, because we're getting, coming to the end here. So the bottom line is this: we brought up Tin Stoffel before, right? There is no such thing as a free lunch. And as an investor, as a client of an advisor, as a DIYer, you should just want to know what you're paying and understand the possible costs, not just the ones that you can see and are obvious, but the ones that sometimes you cannot see or maybe are just a lot less obvious. So that's important. The other thing that I'm just going to give a quick example, kind of an anecdote, to help drive the point home. So hopefully this is seared into your memory. But Matt, you and I typically, as financial advisors, the type of assets we're mostly talking about advising on are investable assets, right? Well, stock market, brokerage accounts, IRAs, 401ks, things like that, right? But there are other assets in your life, right? Whether it's a car,
right,
or it's your home, or it's other physical, just personal items that you have. It could be land. There's just a lot of things, right? Any of those assets that you own, if you go to trade them out, I decided to get rid of a car and buy a new car. I decided to get rid of my house and buy a new house. I decided to sell off some land that I own. I just, whatever it is that you have. Are any of those transactions free?
No.
I mean, you may make money.
Not that I know of.
You may make money,
right?
Like you bought your house for $500,000 and sold it for $1 million kind of situation, or typically not making money on cars, but let's just say you're one of the lucky ones that bought a car and actually made money on the way out. That still doesn't mean that the transaction was free.
Right.
Everybody knows that when you hire a realtor, you're going to pay them to make this transaction happen. Whether that's for just a piece of property or it's for your primary residence or whatever it may be. When you go to sell a car or buy a car, you don't just pay for the car itself. There's all these embedded fees and expenses laid out when you go to buy that car that you're going to pay to the dealership or to the bank when you open a loan. Even if you go to open a loan, there's transaction costs. They don't just give you the loan and charge you the normal interest. They're also going to charge you a bunch of money up front to open the loan, originate it. And then they're also going to charge you interest as you go. And so we know this exists in all these other areas of our life. Yet when it comes to our invested assets in the stock market and we're moving around money, people tend to lose sight of the fact that there's probably some costs associated with that.
Right.
But when you compare it to everything else in life and you just stop and think about it for a second, you're like, well, yeah, that doesn't make any sense. And every mental picture everybody has of Wall Street is not a guy in a cheap suit driving a rust bucket of a car. It's the opposite.
Right.
Well, if that is real and that is true, it stands to reason that somehow, some way, they're making money and a lot of it. Right. And so it's not that we can get out of all fees and expenses. That is not the goal. It's just like taxes. You can't get out of paying taxes. It's just like we talk about this all the time. Pay your tax bill. Just stop tipping the IRS. Just pay the bill you should pay. Pay the fees and expenses that are fair and commensurate to your situation. Just stop tipping in all these different areas, whether you're a DIYer or you're working with an advisor on either side of the fence, commission-based or fee-based. Just important that you know and understand. And I guess our goal of this podcast was just simply that. Just give the education that, because sometimes when you don't know what you don't know what questions to even ask.
Right.
So hopefully if you got anything out of this episode, it's that. Now I know what to ask. I know what to be thinking about. I know what to be aware of, and give you the tools in your tool belt to be able to have those conversations to know. Because the goal is not to get to zero. Because it's also true that cheap usually means cheap. Mm-hmm. Not always, right? But you get, and most times in life, I think everybody would agree with this, you get what you pay for.
Right.
For the most part. Every now and again, there's some arbitrage and you get a good deal and stuff like that. But generally speaking, you get what you pay for. And so cheap doesn't mean good and expensive doesn't mean good. Again, it just has to be kind of commensurate with the value that's being given back to you. And some of that is subjective, family to family, but just important that you know. And
to be fair, if I did want to get it to zero, I could put it in a coffee can in the backyard. Right. But
that's not free either.
But there's opportunity cost. So there's time, there's opportunity. Tinstoffel. I think that kind of sums it up.
I think that's the name of the episode.
Yeah.
All right, everybody. Thanks for listening to this episode of Every Day is Saturday. Again, my name is Brad Gatto, here with my co-host, Matt Stahl. Happy that you could join us. If you want to find more information out about Fiat Wealth Management, you can go to our website, fiatwm.com, fiatwm.com. Not only is the podcast there, but all of our inner circle workshops, educational workshops we do, blogs that we do, fun events that we have, happy hours, things like that. Come be a part of the family. We would love to have you join us in our educational endeavors, let alone just hang out with us in something like a happy hour. If you have not yet subscribed to the podcast, we would recommend that you do so that you know when all future episodes come out. And just remember in this episode that there is no such thing as a free lunch. You do have to pay for things. Hopefully what you're paying for, you understand, and it's worth it. See you all next Saturday.